For decades, scale was the ultimate symbol of success. Bigger market share, broader geographic reach, larger product portfolios, and rapid expansion were seen as the clearest indicators of strength. Growth was often measured in how far and how fast a company could expand. But today, a different pattern is emerging across industries. Many companies are choosing depth over scale. This shift does not mean businesses have abandoned ambition. It means they are redefining what durable growth looks like. In a market shaped by volatility, higher capital costs, intense competition, and shifting customer behavior, expanding everywhere at once can create fragility. Depth, on the other hand, creates control. Choosing depth over scale means focusing on strengthening core markets instead of constantly entering new ones. It means refining existing products rather than launching endless variations. It means deepening customer relationships instead of chasing raw user numbers. It is a strategy rooted in quality, precision, and resilience rather than sheer size. One of the biggest drivers behind this shift is economic uncertainty. When demand patterns fluctuate and financing becomes more expensive, rapid scaling increases risk. Every new market requires infrastructure. Every new product line adds operational complexity. Every new region introduces regulatory and logistical challenges. In uncertain conditions, complexity multiplies vulnerability. Depth reduces that vulnerability. When companies concentrate on markets they understand deeply, forecasting becomes more accurate. Customer behavior is more predictable. Competitive dynamics are clearer. This clarity improves decision-making and strengthens margins. Higher interest rates have also changed the math of expansion. In previous years, cheap capital allowed companies to fund aggressive growth even if profitability lagged. That environment has tightened. Today, investors are more focused on return on invested capital and sustainable cash flow. Expanding rapidly without clear profitability is viewed more cautiously. Depth often improves profitability. When a company concentrates on its strongest products and customers, it can refine pricing strategies, optimize supply chains, and enhance service quality. These improvements strengthen margins without requiring dramatic increases in scale. In many cases, deeper penetration of an existing market produces better returns than entering a new one. Operational efficiency plays a critical role here. Scaling quickly can strain systems and dilute focus. By prioritizing depth, companies can streamline operations and eliminate inefficiencies. Fewer moving parts mean better execution. Better execution leads to more consistent performance. Customer relationships are another key factor. In saturated markets, acquiring new customers can be expensive. Retaining and expanding relationships with existing customers often produces higher returns. Businesses are investing in customer experience, personalized services, and loyalty strategies rather than broad expansion campaigns. For example, instead of launching new product categories, some companies are enhancing core offerings with incremental improvements. Instead of opening locations in entirely new regions, they are optimizing performance in established areas. Instead of adding layers of complexity, they are simplifying product lines to focus on what customers value most. Technology supports this focus on depth. Advanced analytics allow companies to identify high-value customer segments and tailor offerings precisely. Data-driven insights reveal which products drive the most profitability and which drain resources. With clearer visibility, leadership teams can make disciplined choices about where to concentrate effort. There is also a strategic advantage in specialization. Companies that develop deep expertise in a particular niche often build stronger competitive moats. Their knowledge, relationships, and brand positioning become harder to replicate. Broad expansion can dilute that expertise. Depth reinforces it. Choosing depth over scale also enhances resilience. When organizations expand too quickly, they often carry higher fixed costs. In downturns, those costs can become burdensome. Focused businesses with optimized operations can adjust more smoothly to changes in demand. Stability becomes a strategic asset. Investors are reinforcing this shift. Markets have shown a preference for companies that demonstrate consistent margins and predictable earnings rather than explosive but unstable growth. Depth aligns with predictability. Scale pursued without control can produce volatility. Culturally, depth creates alignment. When teams understand core priorities clearly, execution improves. Rapid scaling can create fragmentation, with departments stretched across too many initiatives. Focus fosters accountability and clarity. Importantly, depth does not eliminate growth, it reshapes it. Instead of expanding outward aggressively, companies grow inward by increasing share within existing markets, improving lifetime customer value, and strengthening operational performance. This type of growth compounds steadily. The broader global environment makes this strategy even more relevant. Supply chains remain sensitive to geopolitical shifts. Regulatory frameworks vary across regions. Currency fluctuations introduce additional complexity. Expanding internationally requires navigating all of these variables simultaneously. Many companies are choosing to master fewer variables rather than juggle many. There is also a branding dimension. Businesses that focus deeply on a defined identity often build stronger reputations. Customers associate them with expertise and reliability. Sprawling expansion can blur brand clarity. Why are many companies choosing depth over scale? Because depth offers control, it enhances profitability, it reduces operational risk, it strengthens customer loyalty, it builds durable competitive advantages. Scale is still powerful when supported by strong foundations, but scale without depth can be fragile. In volatile markets, fragility is costly. Depth, by contrast, reinforces stability. The companies thriving today often share a common characteristic. They know exactly where they excel, and they concentrate there. They resist the temptation to chase every opportunity. They evaluate expansion carefully. They protect margins before pursuing growth. In previous eras, being the biggest was often synonymous with being the strongest. Today, being the most focused can be more valuable. Depth creates strength from within. It builds expertise, loyalty, and operational excellence. Choosing depth over scale is not about shrinking ambition. It is about sharpening it. In a world where uncertainty is constant and capital is more disciplined, precision often outperforms expansion. Many companies are discovering that sustainable success is not measured only by how wide they grow, but by how deep they build.